Excellent, thank you. We have a new recording secretary, Stephanie. So if everybody could identify themselves when they speak, at least for the beginning of the meeting, so it would make it easier for her to do the minutes. I appreciate it. So let's call the JRIB meeting, March 25th, to order. First item on the agenda would be approving the minutes from the February meeting. Would anybody like to make a motion to consider those?
I make a motion to consider.
Okay.
Nick.
Leeper. Anybody like to second that?
Joe Quinn will
Joe
second.
Quinn will second that. Okay. Does anyone have any comments or edits or changes they'd like to suggest? Eric?
So the fourth line from the bottom says bond space. He thinks the board should consider it as an option. Strike, thinks the board should consider it. And replace with.
Eric, I'm sorry, where are you?
These are the fourth
new
line from the bottom.
suggestions versus the.
I'm talking about, you talking about minutes?
What?
You talking about minutes?
Yeah, we're talking about the February minutes.
Yeah.
But which page you want?
Sorry, the last page.
Oh, last page.
Yeah, fourth
Okay.
line from the bottom.
Okay.
So strike, thinks the board should consider it. Replace with, had concern about its growing size in the bond universe as an option.
Okay,
I
so-
wasn't supporting it, I
remember.
had concerns about it.
Yeah, yeah. So just repeat that again for Stephanie and for all of us?
Yep, we're striking, thinks the board should consider it. Replacing it with, had concern about its growing size in the bond universe.
Okay, I think that is what you, yeah. Thank you.
A copy of the notes, I'm sorry. I read them, but they're on my PC.
Are there any other comments or changes anybody'd like to suggest?
Thanks, Stephanie.
Anybody in the peanut gallery on Zoom?
I saw them today already, but I just.
No?
opened that.
Nothing from me.
Okay. I'm good.
We do,
Yeah,
as amended.
got it. Okay. If there's no other changes, do we go straight to a vote, or we have to, with the amendments?
I think you can make a motion.
Yeah, motion to accept the amendments? Everybody have an opinion on that?
You can vote to approve as amended.
Right, so we can go straight to the vote. Okay. So we'll take a vote to approve with the amendment that Eric included. All in favor? Aye?
Aye.
Any
Aye.
opposed? None? Any abstentions? Okay, unanimously approved. So the remainder of the meeting, as it should be, will be Josh Barbash's department. The only thing I will add is I've asked Josh, so we could put it under new business, I guess. In the news, it's impossible to miss the concerns and downgrades and so forth in the private credit space. It's all over the place. And so I asked Josh if he could just give the board a little bit of a description and discussion about what's going on, high level. I don't want to get too deep. And then maybe discuss with us if any of that affects directly or indirectly our portfolio. And then I also think, again, to think a little prospectively, I asked him if it was worth, if this turns out to be some sort of calamity, there's going to be a lot of breakage and a lot of secondary selling and funds that might prop up that are going to try and pick up the wreckage, so to speak. So I asked him to also, it's probably a little early for that, but just as a thought process as to whether that's something, we're not particularly tactical as a board, but this is a big component of the financial markets that is going to have some dislocation. And it could be an opportunity for us to pick up some yield in lieu of some of our fixed income. So I just asked him to look at that as a whole, and I don't think we have any decisions to make on it at this meeting, but I do think it's worth understanding, both in general and how it might affect us. So we can call that new business. Yeah. Okay.
Talk about it at the end.
Yeah, at the end. So turn it over to Josh.
Great. It's good to see you all in person. I had to wait for all the snow, so it's nice to see green grass out here. I'll kick off with the monthly performance update. Give a little bit of color about March as well, which has certainly not been as good of a month as the last several have been for the funds themselves. Overall, February, I mean, we met almost the last day of February, so I gave a very broad kind of color there. Certainly, global equities continued to deliver in February. Again, emerging markets were the star, up 5.5% in the month. Developed equities were up only about 1%, but that's dragged by the U.S. It was down almost 1%. And regionally, it's been very broadly scattered. Japan continued the rally from the beginning of the year. They had their elections with a more aligned government that seems very pro expansionary policy, and so Japan prior to March was up about 11% year to date. So again, the payoff of being diversified in your equity allocation, you're broadly 60-40 in terms of 60% in U.S., 40% non-U.S. You benefit when other regions rally. We've seen a very long-standing U.S. rally. Certainly valuations have favored non-U.S. equities at points over the last 2 years, and that's sort of driving the equity markets there. Fixed income yields came down, so your fixed income returns were also very positive for the month. 10-year U.S. Treasury was down about 30 bips. The market was pricing in 2 rate cuts in the U.S., rate cuts elsewhere in the world. That's obviously reversed itself, and even today, the markets are actually pricing in the potential for a rate hike in the U.S. The U.K. has gone from 1 rate cut to 3 rate hikes. So you can see the tension of rising inflation, what's going on in the Middle East, the potential supply shock coming in with oil, and we can talk about March there. But certainly for the month, both portfolios up about 1.5%. Fiscal year-to-date performance continues to far exceed, or at least at the end of February, far exceeded the 6.9% expected return discount rates that you have for the liabilities. You'll notice both funds, the private equity returns are 0. We still have not gotten to 12/31. This is pretty typical, and if you remember from last year, I don't think we got the 12/31 private equity prints until either very late April or very early May. And so that'll obviously flow into performance when we eventually get those. But being that quarter lagged, right, the end of the year last year, a little bit up and down, but overall equity markets were strongly positive. The private equity investments are generally regionally allocated, still predominantly U.S., but again, exposure in Europe and Asia and Japan, and we expect that those prints will be positive, and so that'll bump overall performance there. Still on a fiscal year to date, that kind of first quarter plus of private equity up 6% in that first quarter. So, on that 1 year basis, really strong performance. Equities have continued to be the story. The fixed income assets are churning yield. You'll look at a 1 year return of almost, a little over 5.5% on the fixed income portfolios. You're broadly allocated, and so that's generally around the yield rate. Rates had been relatively range bound until this month. March, even before the Middle East hostilities, the U.S. markets, we were seeing a little bit more tumult, a little bit of softening of economic data. GDP print, I know we talked about this last month, but Q4 GDP print came in at, I think it was 1.4% versus Q3 had been 4.4%. But obviously the U.S. government was shut down for half of Q4, and government activities tend to be part of GDP growth, so that was an actual drag there. The expectation was Q1 would reverse, but we're not so sure that we're going to see a big bump in growth with the hostilities in the Middle East. Labor weakness, job numbers in February were detractive. There continues to be questions around the labor market. A lot of concentration in healthcare as the main driver of where job growth has been, and if that starts to soften or weaken, the private sector has not been adding jobs. And then there's sticky inflation. So from a macro backdrop, it's getting a little bit dicier, and then obviously you add in a potential supply shock in oil and inflation there, and the macro backdrop is a little bit weaker. At the same time, corporate side has been very strong earnings, strong cash flow. That remains to be the kind of view on equities and corporations as a whole, that they're continuing to drive returns because the fundamentals are still extremely strong. Certainly, the input cost of oil, again, we'll come back to that, may weaken, but we looked at Q4 earnings and there was something like 75 or 80% of companies exceeded expectations. You continue to see a broadening out of earnings. The earnings growth that we saw from the mega cap tech continued to be there in the 20-ish% range, but you saw some of the small caps, you saw broadening out across industries, where you're seeing that creep up to high single digits, low double digits, which has been the expectation that there would be this broadening out, and that overall, earnings expectation in low double digits, but getting a lot of support from the rest of the economy. Remains to be seen. Certainly, a quicker exit to this war, and a reopening. I mean, not that the Strait of Hormuz is closed. Oil tankers are going through, just not U.S.-linked oil tankers. But certainly, there's going to be disruption. Right, there's definitely damage, to energy infrastructure in the Middle East. Remains to be seen how long or what kind of damage that does. It certainly helps in the U.S. being a bit energy independent, and so. I think that there's just a lot of uncertainty, which is also why every day you might check out the markets at close and it's either up 1.5% or down 1.5%. Really just depends on what is either tweeted or truthed in the morning or a story that comes out in the middle of the day. I think it's the market is just looking for, trying to put some idea of where we're going to go from here.
How much of a dent approximately has March put in this road?
Yeah, so we can turn to page 6. We'll talk about the pension portfolio first. So at the end of February, you were at $541 million in the portfolio. As of yesterday, that's 518.4. So that's down 4.2% for the month of August, for the month of March. But if we look at global equities, are down 6% this month, which puts global equities down 2% year to date. Again, U.S. is 65% of that, and the U.S. is down 4.5% this year. I'm sorry, down 4.5% this month. Europe is down 8.5%. Yeah, Japan down 10% this month. Right, they had that big rally. Certainly, as you get to to the Far East and Southeast Asia, the impact of oil restrictions or less oil coming through. A lot of China's oil supply comes from Iran, and you see it also in Taiwan. You see it in the Southeast Asian economies that had actually rallied for most of the second half of last year and into the beginning of this year. And so it's a lot dragged by that. EM is down about 8%. Still positive year to date. It's the only region that's positive year to date. So again, place to still be diversified. Rates have backed up. The 2 years up 50 basis points this month, which is implying that we're not going to see Fed rate cuts. I mean, that's where you're starting to see the backup there, and it's been across the curve. The long end has not popped as much as we expected. You would expect the long end to start moving up if inflation expectations start to grow. So as we see how long the shock is going to last, what the price of oil is going to be, if oil stays at around $100 a barrel, that's not damaging to the economy, but that's going to lead to a 3 or above 3 print in core inflation, which is kind of the Fed's main measure. And if you see inflation stick above 3, weakening labor market, the Fed kind of has this dual, are we going to help support labor and we need to cut rates to kind of stimulate the economy, but inflation's over 3, we don't want to push too hard and end up in a stagflationary environment. And so that's why the market's moved towards pricing in fewer rate cuts from the U.S. And so we've seen the yield curves move up across the globe. So your fixed income assets are going to be down this month as well, just because rates globally have moved higher.
Do you think that growing up in the markets, I always saw and believed, because it was true, that when stocks were getting hit, bonds would do better and vice versa. And I think we've built our portfolio in a very traditional way, even though we have some alternatives, on the assumption that the fixed income is going to be there as a buffer. And it's certainly not behaving that way, not just this month, but for quite a while. It's been, that link has been broken. 2022 was a bad year, right, for everything. do you think that, again, not for this minute, but do you think that that would be something to re-examine at some point in terms of what we're viewing our fixed income's purpose to be? And therefore which fixed income we're in?
Yeah, I mean, certainly a view of what would be a risk mitigating strategy, if you will. The stock bond correlation had been slightly negative, which is, they're protective when equities go down, but it's ebbed and flowed. You're right, 2022, we saw the kind of longer tail correlation between the two move positive. And it ebbs and flows. Generally, when you see higher inflationary environments, that stock bond correlation tends to be positive, mostly because inflation impacts real rates. It impacts, ultimately what your nominal rate is, and it pushes that up in a higher inflationary environment. Rates moving up means fixed income assets go down in value. And higher inflation environment often means impact growth, and that would impact stocks. And so that's why you see in higher inflationary environments, you tend to see it correlate more positively, which explains a lot of 2022. We saw, 9% year over year inflation. And so we saw that. Certainly, the protective status of bonds has diminished a little bit. What we have seen are pockets of where there's market self. So if we go back to maybe last August, right, that was the first sense of we were waiting for Fed rate cuts. We were waiting for Fed rate cuts. Some of the economic data came in a little bit soft. It was beginning with some labor market data was a little bit soft. There were some questions around growth. The Atlanta Fed does their Fed Now tracker where you can live track where GDP is, if you can believe you can tell today or tomorrow what happens to GDP. But it was looking like growth was not going to hit that 2.5% target. And there was sort of a flight to safety. So equities sold off for a week or two in late July and early August, but bond yields rallied. And so there still is some protective level that bonds give, but it is not in the realm that we saw throughout the 2010s, where anytime there was some market hiccup, everyone just ran to long dated U.S. Treasuries in. And some of that is tied to the fact that we're $39 trillion in debt. That's our deficit. And it's not just the US. Developed markets in Europe, the UK, are all having the same conversation. Our deficit is huge. And how do you reconcile that? Does that make treasuries a safe bet, or does that make Euro bonds or gilts a safe bet when equities sell off? We still think that they play this role, and fixed income certainly plays that role. There's other diversifying assets. What we saw over the last 2 years was gold, right? That was where a lot of investors ran to as their kind of protector against equities. You can have the crypto enthusiasts, I think, at one point believed it would be Bitcoin, that's probably turned more into a levered kind of tech or levered risk on type play. And so
Drug dealers.
but it's been golds, it's been treasuries. Fixed income still plays that role. Rates are still pretty high in terms of what you're getting from a risk-free rate, still in the 4.5 range. And so there's still value in having those fixed income assets as that diversifier, because you just keep clipping that coupon. But there's roles. We've seen a pickup of interest in hedge funds in particular, usually funded out of that fixed income bucket. The expected return on hedge funds tends to be a bit higher than your fixed income bucket. Ag might have an expected return right now of kind of 4 to 5, and hedge funds might be in the 6 to 7 range. And the idea is hedge funds also run a pretty low volatility, and you can create your hedge fund portfolio to be very low beta in terms of correlation to the stock market. And so it'll protect you. It's not going to give you 15, 20% return like an equity would, but it's going to help protect on some of that downside. And so, there are institutional investors that are kind of figuring out, if we have 30% in fixed income, should we have 5 or 7.5% in hedge fund type strategies? Cost trade-off, obviously, there, but that is part of that risk mitigating strategy. And then there's other things,
I would,
infrastructure,
for myself,
real estate.
I would, I think it might be worth, I'm putting you on the spot by just throwing it at you, and you did a wonderful job answering the question. It might be worth a topic for a future meeting, either by you or maybe somebody, BlackRock, who specializes in this, cash management, whatever you want to call it. Because I think from the big picture, it's something we should be thinking about. Things are not always the way they are forever, and it might not be, so I'm just picking this, some 60-30-10 portfolio, whatever you want to call it, may not be the way to go, going forward. I could foresee an environment where, the deficits continue to run at insane levels, which just juices the economy and allows stocks to do great, and rates keep going higher. And if that's the case, the fixed income's not going to do the work we used to think it did. So, unless, I don't know if anybody else would find that useful, but I think getting a primer on that from the BlackRock guys would be useful.
Just a quick question. Now the Supreme Court's taken action on the executive branch's tariffs. Could that be construed as maybe some type of stimulus for the economy? Could it play into future inflation? What is BlackRock's opinion? How does these tariff money that was acquired is going to be distributed and what?
Hey, Eric, could you speak up a little bit, please?
I was asking about the, now the tariff, the action of the Supreme Court on the executive branch's tariffs. Could all of that money be looked at as stimulus on the economy, or how would it affect the economy? Maybe coming too hot.
So, I mean, part of the outlook coming into this year was you were collecting tariff money as part of government revenue, so it's helping offset costs that the government has, helping kind of control some of that debt issuance on top of the One Big Beautiful Bill Act, which was a bit more, consumer-y, stimulating. People are going to get bigger refunds, as well as some of the tax write-offs they had for AI and data centers and things like that. The reversal of the tariffs, certainly this is going to play out in courts for quite some time, I think. The president has a number of options to lay on tariffs. He's already put on, under multiple different sections, kind of his level 15% tariff across the board. I don't think that those are necessarily going away, and he has legs to stand on in all of the arguments for all of these things. Probably can't use emergency powers, but there are different sections of executive powers that he has to do that. So we don't think that the tariffs are going away, and it's very clearly, a kind of a fiscal and economic trade policy that he has. And so, I don't think that President Trump is going to turn around and just say, "Oh, no more tariffs." They'll find ways to make sure that they abide
But
by
I think
some.
Eric's question, if I understood it right, was that there might be a rebating of the tariffs that were collected that have now been found unconstitutional. Is that possible? That's enough money to come back into the economy? I mean, it's actually
a couple $100 billion.
Yeah, it was only.
It's not huge,
Yeah,
though.
they only collected, somewhere around like 200 billion or so. I mean, grand schemes, if the tariff policies had stayed in place, there was kind of expectations this would be somewhere from like 400 to 600 billion collected annually, and that probably was more aimed at, can you control, interest costs on your debt and help fund some of the government activities. Certainly revenue to the government would be stimulative if they can then find ways to spend it elsewhere, which they almost definitely would. We still expect that they'll collect tariff revenues, and so that's still somewhat, if you will, say, stimulative, even though if it's hurting the consumer, it's kind of being used by the government in other ways.
Eric, is that a,
Yeah.
okay.
We can move to the OPEB plan on page 9. We have the same kind of March update. As of the end of April, you're at 115.9. It's not 16 on the page, but you're at 115.9 million in the fund. As of yesterday, that was 110.2 million. So that's a negative 4.8%. So a little bit bigger drawdown there. Again, 10% higher allocation to equities. Equities are down, 4.5% on the month to date. Notwithstanding today, where equities were up about 0.5% today. So fiscal year to date for the OPEB, you're still at 7.6%. Still exceeding that that target 6.9% return. Still many more months. Still a lot of uncertainty, I think, coming in. But still in a good position, from the OPEB fund, from a performance and an asset position. I mean, just looking at the line chart here, just over the last year, going from 94 million up to 110 is still nice growth for the fund. Are there any other questions about kind of funds, the performance? When we come next month, or when we have the meeting next month, we'll have the full kind of quarter update. We'll break out all of the funds. We'll break out all of the line items as well. I think kind of using a quarterly pace for that is a good pace for that.
Just kind of jumping around. I think last month we asked, or maybe the month before, we asked for a breakout of private markets exposures. And looking at the 3 vintages of the HarborVest funds that you presented, the deployment looks odd. I think you guys noted in your deck that they're, I think, bottom quartile for that.
Yeah.
So like the 2021 fund is only 50% invested, but HarborVest is definitely still raising new funds. I mean, how do you suggest we think about that? Because that's capital that we're, I think, paying fees on. So
Yeah.
there's definitely
Yeah.
a drag there.
Yeah, I mean, I think part of what is happening is, you're looking at 2021 and 2022 vintages in particular. So a lot of cash raising, capital raising kind of post-COVID, and there's certainly been raising capital into that rising rate environment. So deal making slowed down pretty significantly in 2022 and 2023. We've seen a rebound. So, the one way to look at it is that HarborVest was not just deploying capital at anything. They're trying to think about where they're going to be deals that make sense for them in the market. One of the things that we highlighted kind of on the last page of this little section was from a market value, from a NAV perspective, the way that they ended up deploying capital and using it to perform. I mean, you look at the TVPI number, their first quartile, their performance on these funds has been really strong. And a lot of it is they entered more secondaries type deals. They entered some co-investment deals. They've IPO'd a couple of funds. The funds, I think both the 21 and the 22 fund had holdings in the Figma IPO. They exited on IPO. They're not holding it. Figma's actually got slaughtered a little bit in the SaaS apocalypse, but they were able to exit that at IPO. They exited IPO of Walgreens Boots Alliance as well. So they had a number of co-investment deals with a number of other PE firms that they just were able to exit out at IPO when deal making picked up a little bit last year. So the way that they've strategically deployed their capital, I think, played more into what the market environment was. And there's a bit more market environment related than it is, they're behind the curve or doing anything like that. Because the performance on all 3 funds
Right.
is pretty good.
Right, yeah, deployment just sticks out.
And then in December, we had $2.5 million capital call for the 21 fund. I have some of these numbers. We had 1.7 million. This is across both pension and OPEB. 1.7 million on the 22 fund and another million on the 23 fund. So that brings your 21 fund is now 53% deployed, 43% on the 22 fund, and 26% on the 23 fund. So they raised a bunch of capital in December to make some deals. Again, the market might be a bit more disruptive here, but there's big talks of bigger IPOs coming this year. Certainly the talks around SpaceX and OpenAI, and there is a bigger belief that there's going to be a much more movement in the IPO market this year and the M&A market this year, which makes it more attractive for them to start deploying capital into investments now. And there's definitely the market feels that kind of 2026 and beyond looks like really good time to get into vintages as well, but HarborVest has been holding back a little bit of capital. So rather than deploying everything in the first 2 to 3 years, which is what you see, that J-curve investment.
I don't have the terms in front of me. Do you know the investment period at all? It's got to run out at some point.
Yeah, so I mean, the fund period itself, I mean, they're going to make investments across the entire lifetime of the fund. The fund lifetime is 12 years, and then they have the right for I'll have to go back and double check if it's 2 or 3 single year extensions. All of your legacy funds have done exactly that. They all have pretty similar terms. I'll have to double check on that. But
Do fees step down at all, do you know? Do you know if fees step down at all?
So the management fee on HarborVest, I don't think steps down, but it's already pretty low. I think it's somewhere in the 25 to 30 basis point range from their management fee, which is on the low end for these type of fund-to-fund.
So it's deployment, so.
Yeah.
What's typical, so like of a percent of capital called, like, let's say we get to year 10. Is it typical for these funds just to get into like the low to mid 90s of capital called? Like you ever expect them to actually get to 100 or like you're like, he hits 95 and
Yeah. I mean, and in the quarterly pack where we bring the other funds, like your Mesero funds are in the high 80s. One of those is a 2013 vintage, and it's like 89% called.
Okay.
And we don't expect that they're calling anymore for that to call. Yeah. Some of the funds do in their agreements have the management fee on called ends at a certain point if they release new vintages. I mean, the idea is, right, then you'll be in another vintage and they'll charge you on the commitment there. Certainly the Lexington funds for sure had that in them where, the Lexington Fund management fee was like 100 bips. And then basically a certain period of time after final close, when they had a new vintage, you stop paying on committed even if they hadn't called everything. And, I think I'll have to go back and double check if the Mesereau had those as well. So, they definitely are a bit slower on the deployment. But again, I think it's been selective and the performance has kind of shown that the path that they've chosen has been good.
I think the other thing that you guys flagged is that there's significant overlap in the three funds.
Yeah.
Yeah,
So-
well, the 21 and 22 funds in particular
Right.
have a significant amount of overlap. It's 50% of the funds. I mean, that may come down as they deploy more capital. Remember, they're only 50% invested, but it's a very clear, they had very select deals that they liked or very select, primary partners that they wanted to get invested in. And they would allocate to a bunch of their funds. They actually have, when we were pulling a lot of this data, they have a 2025 series as well. I don't know what's in that. That obviously is still in the capital raising point now. But the 23 fund is certainly not as overlapped. And, what I find interesting is you can look at the NAV basis. All of them on a NAV basis have allocated to secondaries. That was and continues to be the better performing part of the private equity market. And that's, again, where they've deployed, and the 23 fund is a bit more made up there. And some of that is because the primaries funds are still deploying capitals themselves. And so they have not built up big NAVs yet. They have not deployed a ton of that capital. And so you'll see that shift. I think their expectation is the fund itself should be somewhere in like the 70 to 75% range of primaries. And so eventually this will cycle back and they'll launch into what they think will be attractive primary fund opportunities.
Yeah, I mean, do you have thoughts on, we're getting complexity by investing in three vintages, right? And we're not necessarily getting diversification that we would be aiming for.
And I think it's probably more of a focus on the OPEB fund in particular, where that's the only investments that you have.
Right.
From a pension fund perspective, right, you have your legacy funds where Lexington is only secondaries. So you have, exposure to secondaries there. And the Mesereau funds are like 90% or 95% primary investments. And those are much older vintages. You have a 2013 vintage, you have a 2017 vintage where, they've bought into some primary funds in 2019, 2020 that aren't in the
Right, whereas in
Harvard
OPEB,
funds.
you
So-
may say, oh, okay, I'm in, three funds, but like you really should, you can even think about it as one line item.
Yeah, I mean,
To
it's
some degree.
the overlap. And so, in terms of the allocation basis, you're right, thinking about it maybe as one or 1.5 line items in that, given the overlap, it's still also, you're still also pretty far under the target allocation of P in the OPEB fund. Part of that is HarborVest being slow to call the capital and actually deploy it. And some of it is, the sizing of the commitments that were made, especially the 23 fund where the commitment really fell off a cliff in terms of what you signed up to do. And so there's probably room, and it probably does make sense on the OPEB fund in particular to consider if, you've kind of accepted the 10% allocation or target allocation to private equity of looking at a not HarborVest
Right.
allocation in terms of private equity. We can certainly, I know last year we came up with a pacing study to walk through what types of commitments keeps you at 10%. And I think a really good question, we'll bring our private equity experts is, how do you guarantee a bit more diversification in our allocations? Again, if you look at all of the allocations, right, I think that one of the other leading questions on this was how concentrated are we in tech and software? And, if you're thinking about 21 and 22 funds investing in software coming out of, and this might tie back to some of the private credit comments later, but, that's been the story. And you saw some of the damage, Claude comes out and says, we'll just do everything that SaaS does. And everyone's like, well, of course, they're all going to go to zero. And so maybe some of the venture pieces in some of these 21 and 22 vintages, that was their goal, kind of coming out of COVID. Everyone's working from home, everyone's remote. There's going to be all this great software investments. Maybe they'll look to find something else, but they are kind of all allocated in very similar ways. This isn't to say HarborVest is making bad investments here. You are just concentrated
Right.
in how HarborVest is going to allocate this fund. And you can think about maybe we want to diversify some of the sector exposure, and we need to not have HarborVest.
Yeah. Feasible.
if that makes sense.
Do you find that different PE shops have different cultures too? Like, depending on the PE shop, which way they're gonna lean? So let's say, for instance, we have a very large concentration in information technology in Harborvest. Maybe there's other shops out there
They definitely
that may have another specialty.
They definitely have, yeah, they definitely have their own strengths. I mean, one of the things about the fund-to-fund approach, which you have with HarborVest, is they're allocating across a wide range, especially on the primary side. You know, so if we look at page 15, right, your commitment level right now, you know, it's in the 60s to primary. Right? They're going to do their sourcing and assessment of who's really good at, let's say, healthcare. And we want to invest there, and they're going to pick. And so from these fund-to-fund approaches, you know, you're going to get that survey, and with a big name like a HarborVest who knows the market and knows these managers, has worked with these managers for dozens of years, you know, they know what people are good at. I think, you know, we had my colleague, her name is Annie, was here. That was one of the things that she commented on when they look at, you know, for their fund-to-funds, when they look at who they're going to allocate to and do they keep allocating to these managers, they focus a lot on what is your culture, what do you know, what have you been good at, and if you start to deviate off that path, we don't need to allocate to your next vintage, we'll just pick a different manager. And that's one of the nice things about the fund-to-fund approach is you're not going to deploy all your capital at once into one manager, you're going to be thoughtful about that pacing. I mean, again, that's what HarborVest is doing here. They're being clearly very thoughtful in terms of finding the right allocation. In terms of the concentration itself, again, I come back to the point of like, that's going to be characteristic of 2021 and 2022 vintages. As you're raising capital, the investments that primary funds are going into at the time is what is driving the economy at the time, which is a lot of tech and software startups. What I will say is all of the HarborVest holdings, they're leaning more towards buyout than they are towards venture and growth. I think some of the SaaS apocalypse might hit some of these venture type investments, especially if you think about AI. It's like anyone coming up with an AI plan, you're kind of praying that a big PE fund is going to throw you a little bit of capital, and the venture funds are hoping that those go from a $1 million investment to a $100 million company, and that's the point of venture. But a lot of those go to zero in all markets, not just this one, but this one certainly seems to have heightened volatility around that.
The new .com.
There will be winners. So some of these ventures will be the next Google, and you get in at the ground floor on a Google, and that is very, very beneficial to your fund. But that's part of venture. But they're looking more at these growth and buyout type investments, and on the buyout side, that's where I said the market's picking up a lot on this M&A activity. And again, if they've been holding back and now they're going to deploy into a more frothy M&A market, that would be beneficial to the performance of the fund as well. Yeah, broad takeaway, and you were definitely right. On the concentration, that's definitely something that.
Yeah, thanks for those slides. Those were
You definitely should
helpful.
think about,
I did it out well.
Yep. And again, we'll have our private equity team do another deep dive on PE. We'll bring in all of the legacy holdings, the Lexington and Mesirow, so you can kind of get a better sense. In terms of those funds, the Lexington funds have done pretty well for their lifetime. They're generally in that second quartile performance, and the secondaries market was pretty hot for the last couple of years, and so you've seen some decent performance. The Mesirow funds are a bit more mixed. The older vintage, which you've been getting distributions from now basically monthly on the Mesirow fund, is much lower in terms of their performance. I can't remember if they're third or fourth quartile, but not as strong of a performer, which is also why if you look at just the historic PE performance, the OPEB fund has actually been over the last 3 years outperforming because the HarborVest funds have been really strong and the other funds have been a bit more second quartile in terms of performance. And so you're getting a higher performance, if you will, from the HarborVest and the OPEB.
Higher concentration, yeah.
Yeah, well, yeah. The investments that they've made have worked out. Right. So that's, I guess, been a good takeaway.
Any other questions on the topic? Anybody on Zoom? Don't want to overlook those people attending remotely.
Nothing from me.
Okay. Josh, you may.
Yep. No, the other part of the agenda, this was kind of part of the broader SA topic. I don't know if you want to go back through the memo, we can do that at the end, maybe, just approving the kind of process memo that we all went through. I mean, again, I think it's great documentation and really good governance to have this documented process so that anyone can kind of pick it up as they join. And, I think it's great that we'll follow a very rigorous process to review the asset allocation. And I think Chris had an add to the memo of, we can check back in on the asset allocation on an annual basis. Is this still working? Or, to Ken's question, should we think about something from a diversifying bucket? There's been 3 years of really strong equity returns. It seems it may have gotten a bit extended, a little hiccup, a little correction, but bonds aren't helping. Should we think about something here? That's a little bit less than a full, what we just went through is a full asset liability study. Where we pulled in your liabilities, we pulled in the funded status, checked on do these asset allocations impact, contributions and all of this. And I think we landed at a broad mix of risk-seeking, return-seeking assets and risk-mitigating assets, predominantly fixed income, works and is working for you. And, we didn't need to overhaul the whole thing. But I think on an annual basis, just checking in, are we good here? Do we want to remix a little bit?
No problem with a recommendation to do it on an annual basis. I feel like we do it on an ongoing basis, if you know what I mean. In other words, I don't want us to think as a board that we can just go on cruise control for 11 months and then in the 12th month, we're going to all of a sudden take a look and say, hey, do we like what we're doing here? So I have no problem. I mean, is Chris recommending that we add that into the document?
Just that, I think it's much more that you'll be reviewing. I mean, I agree, the ongoing review. We're going to bring asset class education. We can talk about risk mitigating strategies. We can talk about infrastructure. I think there's been interest in, and all of these things are meant to just stir ideas. Is there a better, should we consider something in this bucket or this bucket? And rather than just say, well, we can't talk about that now. We don't talk about our asset allocation until 3 years from now is part of the reason to kind of think of it as, your annual checkup on your allocation. We've been talking about this. Should we do something here? But I agree. You're kind of ongoing reviewing. I mean, that is a very true statement.
I'm always reluctant, personally, this is just me speaking. I'm always reluctant on something like that to put a hard and fast rule in, because then if for some reason we don't do it for 14 months, because we saw no reason to, and then somebody comes and says, hey, you violated your documents. So that's just my personal opinion. I like what we did, and I like the way you memorialized it, and I like the way it's a document that, because you made a good point. We have a staggered, like the Federal Reserve, we have a staggered terms here, right? We don't all one day just up and leave, right? Over time, people are coming on, coming off. So it's a good document for somebody coming onto the board to be able to take a look at. Whether or not we want to put in there, 1 year is some sort of, I don't know, I don't think it's a big deal one way or another. I don't know if anybody else has an opinion on it.
Is there anything?
For what it's worth, I would suggest that we just maybe put in the language, and I don't recall the exact language used, but target or expected or, something a little perhaps soft to make it, again, not a rule, because I don't think a rule makes sense here, but I think a target does make sense. So again, subject to whatever the wording is currently, I think a soft target type of wording is appropriate.
It's like monitored annually.
Oh, I like that. Monitored annually. How does that sound, Tom? Monitored annually.
Love it. Absolutely love it.
We're just channeling your brilliance, that's all. What were you saying?
I'm flattered, Ken. I'm
Thank you.
blushing. You can't see that I'm blushing.
Yeah, thank you for not showing us your face on there. Yeah.
I think we had talked about at previous meetings, like a board packet of like.
Yes, definitely.
Like, what are the policies and what is that surrounding it? Does that document say anything?
Well, this is
about
certainly
the
a start.
review? So,
Yeah. This is certainly a start. It's true, we really don't have a manual. Right. For new board members, we don't have something we just hand them.
The manual comes with Eric's phone number.
Yeah, right.
But in doubt you have a question.
That's right.
But I thought there was, I'd have to look on the, I thought there were some policies or things out there.
Town charter?
Yeah, there's some,
Stuff from the charter.
yeah.
Right, yeah, but not at this, not board level.
Yeah.
You know, I wouldn't mind working on something like that.
I know, it's,
Trying to
we've
get
talked about that
a
before.
Three-ring binder, or maybe, you
Right.
know, something of information that when a new member joins,
Mm-hmm.
you've been anointed with all of this
Yeah.
information to study and be tested on it.
Especially the tested part, right? But even all the members' names, emails, and phone numbers.
Yeah, I'll take that on.
Would you be willing
I'll
to,
take
would
that
you,
on.
would you like
I'm on
a,
a deadline, but I'll take it.
no,
on.
definitely, would you like to turn it into a
3 years.
a subcommittee, and would you like somebody else
I'll
to
just,
do it?
I'll just work on it and I'll see
Okay.
what I can pick apart and
Okay.
then bring it back for some input and then we
Right.
can formalize it.
Okay, throw it through ChatGPT a few times before you bring it.
We'll work on something.
Okay.
We'll work on something.
Monitor you annually and.
Right, and we'll monitor you, right, exactly.
Every 3 years.
Excellent, okay, that's a great idea. No, I appreciate that, Eric. That's good. That's excellent. So, okay,
And then the last order, I think, is, you know, kind of tying up the SA review. We kind of worked through the asset allocation and, you know, came to a decision to keep the asset allocation as is. And the last part is, you know, just thinking about benchmarking, you know, well, you know, residents of the town, the employees of the town, that's really who you're really doing this for, but you all report up to the Board of Finance, and you have other stakeholders that you need to, you know, be able to explain performance to or what's going on. You know, we can talk, you know, we brought this up at the risk workshop meeting back in August. How do you monitor performance? And on page 17 are a couple of different types of benchmarks. Importantly, you know, and you all decided on this at at the last meeting with the actuary of your discount rate, 6.9%. That's the return that you're trying to target. And that's the easiest benchmark to have. Did we perform better or worse than what we wanted to do? You know, if we go back to that risk workshop, you know, we recognize that, you know, there's going to be years you're not going to hit that 6.9%. There's years you're going to far exceed it, as you have the last couple of years. And all that means is, you know, the JRIB 15 years from now may thank you or not thank you, depending on whether they need to consult the actuary for more contributions or less contributions. And that's a really big piece. And so one way to maybe think about, you know, less than 20-year horizon and not just looking at 1 year over year performance is the fact that, you know, you could naively just allocate to public market equities. And we talk about a policy benchmark. And that's really just kind of saying, we have this expected return, it's 6.9 or 7%, and you can make an allocation that's just global equities, global fixed income in some weight. It might be pretty high risk portfolio to hit that return. It might not be high risk portfolio. It depends on what your expected return target is. But we as a board have made decisions to allocate to private equity, or we've made decisions to allocate to other asset classes. Have those helped or hurt the performance? And helps you also explain, we didn't hit 6.9%, what happened? And, you know, it's just a way to evaluate performance versus just a public market investor benchmark.
well, I'll just say that I don't think personally that if we're 6.9% is not a good, if we were just having one benchmark to measure our performance, I mean, that would be awful, right? Because there's great years in the market where if we only made 6.9%, we did not do a very, very good job, right? So we could be congratulating ourselves because we made 7.2% when the markets were up, you know, 28%, and you know, equities were way up, bonds did okay, privates were great, and we lagged horrendously, and yet we still beat the 6.9. I don't think any of us would be dancing around like we did a great job. So there's got to be some other. In other words, the 6.9 is what it is, right? It's
It's
what
the
the
North
town.
Star.
It's what right. It's relevant for sure, but I don't think it's relevant in terms of us doing a good job, right? It's relevant to the town for budgeting purposes and all that kind of stuff, but it's got to be something more related to. And of course, the hard job is what are the markets, right? How do you possibly bet? But I'm saying there's got to be some way to.
And so what this policy benchmark would be designed to do is say, to meet that long-term return, we needed to take risk in the portfolio. And as prudent investors, we understand that diversification may help us achieve that return for less risk. That's kind of the real goal that all investors are trying to do, is how do I maximize return and take as little risk as possible? And this would just be a way to help, level set on, to your point, yeah, markets might not behave and you don't hit that 6.9, but that's also part of the fact that markets
Yeah, I mean, there might be
help
some
get
year
you
we
there.
make 3.5, and we've done a hell of a job,
And
right?
many investors would choose very different portfolios than you might have. And so one way to judge yourselves is, a very naive investor would just say, I'm only investing in equities and I'm only investing in fixed public markets. And to get this level of return, I needed to be 70% in equities, 30% in fixed income. And then you can help manage, internally of, we had to take risk in this position because equity markets weren't doing well, and we had private equity, and private equity performed better, and therefore we outperformed this naive benchmark, this naive investor, or underperformed this naive investor. And so that's one way to track, overall performance of the portfolio. The second would be a strategic asset allocation benchmark. Those are more commonly used when you're talking about a more actively managed portfolio. So you're really using that of, did my managers add value above just broad indices? And so you have U.S. equities, non-U.S. equities, U.S. fixed income, non-U.S. fixed income. Your strategic asset allocation benchmark would be weighted based on what your allocation to each of those were. And if you had active managers, you're hoping that the active managers outperform their benchmarks, and therefore at the total portfolio level, you outperform those benchmarks. There's a bit more detail on those on page 18. Ultimately, BlackRock, where we are helping manage portfolios, and we're managing portfolios, we typically have this type of reference portfolio, this policy benchmark is what we call it. We call it a reference portfolio. It also helps level set the next time we do an asset liability study. We can look at this reference benchmark and say, okay, it was 70-30. 3 years from now, are there ways that we might want to adjust within the equities? Do we want to take risk here or here? Do we want to be ACWI weighted? Do we want to not be ACWI weighted? And these would be decisions that the board is making to hopefully perform better than just a naive investor and meet that 6.9% return objective. Ultimately, from the SAA perspective, we can build one. The active places where you are private equity and real estate, which are not kind of daily valued. I mean, we've obviously talked about these, but even the indexes for here are quarterly lagged, and they don't tell much in terms of SAA. You make the right active decisions. What we do currently is at each asset class item, you do have an asset class benchmark. So we do look at U.S. equities.
Right.
Do the funds do what they're supposed to do? You're an all index fund, so we want to make sure that the tracking error is still pretty low. On the private equity and the private real estate, the benchmarks aren't passive market investments. They're just broad median manager benchmarks. So when you look
Yeah,
at
how are you modeling those?
so the private equity benchmark, it's the eFront Global private equity benchmark. It just takes the broad list of private equity funds that are out there and looks at the average performance. And so, you want to beat that. You want to beat the median manager, if you will. That shows that the private equity managers you have are good managers. But it's not, really, none of the benchmarks are theoretically investable, though there's no private equity index fund, if you will, right? There's no core real estate index fund that exists. And it's the same thing. The NCREIF Odyssey Index is, just looks broadly across real estate funds and just kind of takes your kind of median manager performance. And so it's much more, did we do better or worse than other managers? Not did we do better or worse than passive way of investing in this index. So it's a little bit hard from an SAA perspective to have all passive on the public equity sides and have an SAA benchmark that's really tracking those, because we're going to look at each line item in itself, and then obviously the other multiple components, the way that you can look at private equity in terms of how are you doing on a bunch of different metrics that aren't just what was the return this quarter or this year.
That doesn't quite fit into a benchmark.
Yeah, you can.
Quick question, if I could, Josh. Are we? Do any of these indexes consider survivorship bias and stuff like that?
It's a good question in terms of funds certainly disappear. So the So the funds that do go to zero or dissolve are not included prospectively. They're not removed historically. The marks are the marks historically, but you don't kind of weigh down the private market index performance by a fund that, is basically dissolved.
And it seems to be a big omission. And I understand we have to use what we have, but that seems a statistically important omission for what it's worth.
When it comes down to the benchmark, like our kind of target expected return versus the quality benchmark versus strategic, I've had clients that are, different, like a corporate pension plans or, state public pension plans, like a couple of the corporates, they stick with, they have a target return they need to hit every year. The publics are more likely to take on like a strategic asset allocation benchmark. It's kind of like the difference in those two, just some of like the actual like accounting and smoothing that they have to deal with. They're like, both of them are very sophisticated and like do a great job, like hit their benchmarks. But like, one guy was like, I need to hit 8.75% every year. And that's what matters. That's what my corporate treasury cares about. And then some of the other ones are like, I got to beat my strategic asset allocation benchmark with like active management. And
yeah, I mean, it depends on your objective. You're probably closer to the former, which is we have this return target we're trying to meet. You have to take risk. You have to take risk to hit 6. Yeah. You're not going to try and aim to earn 0. And so, this policy benchmark, you see it a lot in the endowment and foundation world, mostly because they're trying to say as a board, we went through this risk workshop. We understand what level of risk we want to take, and that is equitable to some public market policy. Now, we think as a board, we can make a decision to diversify our portfolio a little bit more that will help lower risk and outperform, or take the same level of risk and outperform. Obviously, it doesn't always work out, but it helps you. I would not be saying, oh, this quarter we didn't beat our policy benchmark. It's much more of, hey, this past year over the 3 and 5 year horizon, decisions that we made, led to outperformance or underperformance, and then that helps inform, okay, well, what should we do going forward? One answer might be, look, maybe it's the end of private markets and that those decisions didn't work out, and so we're moving away from all private markets and just being this naive benchmark investor. That's one approach to it. But if private markets are really rallying, you'll see this was a way to outperform. Just kind of allocating just to public markets, and it kind of helps inform. If we go back almost a year ago, where we did the return analysis on the pension fund, which was a lot of investigating of, okay, we targeted 6.9, well, we didn't hit it in certain periods. What happened? Why did that happen? And one of the ways that we started breaking that out was, okay, you were allocated in certain ways that the board was, even if not intentionally setting their policy benchmark to be, the policy benchmark would have been X. And then investment decisions were made to allocate to funds or allocate to asset classes that didn't perform as well as public equities. There were periods where those decisions really helped performance. Mm-hmm. And I think we were able to distill that down. And this, I think should be used, especially now, like on a very prospective basis, helping understand over the next year, how did we do relative to just public markets? If we look at, we have the pension, we can go, take the pension as an example on page 19, the naive efficient frontier, just global equities, global aggregate bonds, gets you this efficient frontier. In theory, using capital market assumptions, the decisions you've made to allocate to private equity, to real estate, should help you have higher returns over the long term. That's kind of the prospective looking. We can break down here, but ultimately, where the portfolio is, you're thinking about, a 65-35 investor would earn 6.9% return over the long term. Take on, almost 12% in annualized risk. And so some of your decisions are, we can increase return and lower risk slightly. Mm-hmm. Certainly in the back test, on page 20, we look at that over the last 1 and 3 years, especially. And in terms of this policy benchmark, we can apply it just prospectively. We can think about going back in time. But, really key since probably Vanguard took over, June of 2020, the investment policy changed pretty significantly. You went into passive for your public markets. You had a very specific private equity target. You had the real estate target. And, we can really distill out and do this attribution on a 3-year basis. A naive broad equity fixed income portfolio did better than what the pension did. But we know that private equity has dragged for 3 years, and that's a big driver. We know that real estate blew up in 2022, and that also dragged performance, and real estate hasn't recovered yet in terms of driving that performance. And so that's really a way to then attribute, okay, those decisions hurt the fund performance overall, and that a policy would have returned 15% annualized. And so that's just a way to kind of keep track, especially if we talk about annually reviewing the asset allocation. This would be a way to say, okay, we're drifting above or we're drifting too far below. What's not working? Is there something that we should think about here and really revisit? And this would be a way to just kind of help you monitor the overall performance of the portfolio. And I also think it provides a little bit, to the board of finance, like these decisions worked, these decisions didn't work, but again, look at the past performance. You're still way in excess of that expected return. But to your point, like that's a number, and it's hard to tell.
But somebody would look at this and say, well, you've underperformed the naive benchmark in every single category, every single time period.
And a question would be, should we have diversified? There's the other element. You go back to that 10-year history. You were a bit under-allocated relative to ACWI during portions of the 2010s. So U.S. equity was the only investment at the time, right? And so again, that's decision, should we have anchored to ACWI or should we have set regional targets? Again, it helps align and think through asset allocation decisions over the long term.
You do like a slight risk adjustment here, right? We have
and
lower
we've had much
vol,
lower vol.
much lower vol, and then you get somewhat similar risk adjusted return. That's all.
I didn't say we have to cry too hard. I just said
I was just saying,
some cry.
you underperformed, but
Yeah,
just return, but risk adjusted.
The OPEB against its naive benchmark returned to 23. The OPEB, again, given the 10% higher equity allocation, looks more like a 75-25. It's actually done pretty decently. You're almost equal. But again, you could say, this again, it's net of fees. So you've the net of fee return is in line with this policy benchmark, and you can look at the 3-year number. Again, that's deploying private equity that hasn't necessarily returned as much as ACWI.
Yeah.
But some of that is not in control. The ACWI run-up, public market run-up over the last couple of years has way outpaced the private equity piece here. And so, again, that's just, when we work with, clients, we bucket this as kind of total return. You're focused on a total return. You're not a pension. That's liability relative return, like a corporate pension would be, that might use their liability as a benchmark. This policy benchmark is a way to say, did we take on too much risk? Did we not take enough risk? And that might be a point here, is that maybe the asset allocations relative to this policy, you didn't take enough risk. You could look at the pension, you probably didn't take enough risk. And so that helps align, and we'll revisit that risk workshop, especially as new members join the board. A way to think about, are we too risk averse or are we too risk aggressive? Is another way to think about that too. And so, our proposal is that you add these as benchmarks. It'll show up. If we have our on page 6, the pension fund, there's just these green lines of performance. You can see a policy benchmark return and of performance relative to the policy benchmark in there as well. And I'll add, when we come quarterly, we have that liquid portfolio, and policy, and the liquid portfolio is benchmarked to, the underlying assets. But you could think of that also as a
perfect world, which is not possible. You'd have some sort of survey of the universe of our peers.
That is benchmark 4. Benchmark 4 would be a pure, that one I would not be tracking very regularly. That would be a once a year revisit. I think it's actually
interesting.
I think it's actually in the appendix. The thing is, page 28. These are asset allocations. I'll add we have to troll through the annual financial.
Well, this, you showed us to us last week.
Yeah, and so, we can certainly update, but the asset allocations are all over the place. Everyone has
But
different
as-
discount
But
rates.
as Nick correctly pointed out at the last meeting, they're very tied to the funding ratios of these different towns, right? I mean, it's very easy when you're 140%
That's
funded
true.
Yeah.
to, close your eyes and
Yeah,
do
and so,
something very simple.
on the peer comparison, you can almost slice and dice towns, on three levels. You can look at who's funded similarly to us and how did we perform relative to them. But again, their risk appetite at the same funded level might not be the same, depending on town financials. They might not want to take a ton of risk. You can look at it based on discount rate, who's targeting returns similar to us. You could look at, the 6.75s to 7.25s, you're kind of in the middle there and say, okay, for all of those plans, how has their performance been? And the last one is you can just look at who has similar asset allocations to us. Who's using private markets, pick a couple of the, the plans that have private markets, or if there's just towns that you like to compare yourself to, you can do it that way as well. But, as a not very regular, but, annually or every, 2 years of just how have we done relative.
I
I
think,
always actually never really get like the peer benchmarking, right? Like we're charting our course. Like we need to get from here to here, regardless of what everybody else is doing. Like
well, it's true, right?
like as long as we have a path to get down this trail, like what do we care? I just never really get the peer benchmarking. I'm like,
Depends on stakeholder views and what stakeholders want.
Someone could write about it in the newspaper.
yeah, they could. Like I never get universities like just comparing themselves to each other. It's like, oh, the other Ivies did this, we did that. It's like, oh, we're the worst of the 8 Ivies. So what? Did you make a good return? And
Yeah, but remember, if we're talking about the Ivies, I mean, they're multi-billion-dollar endowments and they're paying their people a lot of money.
Yeah.
So they don't want to just do something, they want to maximize. I mean, in that case.
I mean, but it's like, okay, you're supposed to, their goal is to keep funding their institution, like make their 5% distribution every year and kind of perpetuate their thing. Like if they make 14%, if somebody else made 16, like, oh, is that really terrible? No. So like from the pure
The guy who made 14 would love to hear that.
well, he probably had a bad mark from some private manager. Who knows?
Right.
I mean, it's why if you look at that wheel page, it's the fourth.
Yeah.
And we were throwing it out there, and obviously, if there is if there is a desire, whether from the board or from stakeholders, the Board of Finance, that wants to see, hey, West Hartford or
Well, just to interrupt you,
I support it.
supporting what Nick's saying to some extent, because I was thinking about this. When I go to the quarterly Board of Finance meetings, the only thing they care about is if we're tracking 6.9% or not.
And I think so, because it's like
In other words, they could care less if the markets are up 30%.
They might do something that looks good this year, and then it might be really bad last year because we deviated.
Right.
Like, I don't know if we should really care what anybody else does, as long as we're making our town happy and like our pensioners whole.
Well, I would shade that a little bit, which is that meaning that if we're going to run a fairly sophisticated portfolio with alternatives and so forth, and we're trying to make decisions about whether or not to, commit to a new private equity fund or reduce something here or expand something there, then I think we have to be cognizant of what the total picture is. We can't just be happy with X.
We have
If
to
we're-
be educated on the market and know what's
Right.
out there, and like we have somebody here to tell us like, what is like the newest things in asset allocation or new things that we should consider. But like, should we change just because Westport did something, or should we like go say
No, obviously
what they
not.
do? Yeah.
I mean that's part of it. And I find this maybe useful when making asset allocation decisions of just, we're confident in the direction we're going. We just know out there, hey, some of these other local
it's
pension boards
useful.
might be making.
I mean, if you
decisions.
walked up to a person on the street, this is my opinion. I think the average person on the street, they view the market as what they hear on the McNeil Lehrer NewsHour in the evening when they say, the stock market was up, whatever, 0.2% last night. So on those terms, if our job is to report to our town residents, our 60,000 town residents, I'm not saying that's the right way to do it, then we would just benchmark the S&P 500, we're not doing that. But I think that's what most people think the market is, right? I don't think most people think of a blend of, bonds and stocks and alternatives and whatever.
Most not, yeah.
Right. So, that brings us back to the 6.9, really. Into it. But I will tell you one thing, unrelated, but I was just thinking, like I was at the last quarterly, and I gave them all the wonderful results we have, and I could see their wheels spinning and doing, and just extrapolating out, well, okay, they're up this much, we're halfway through the year, double that, that's what we're gonna be, so,
You're waiting.
Yeah.
You're waiting,
Right.
like, wait, why did
Right.
that go?
Exactly,
there?
so now that we've given back 4%, which is just part of the game, they'll be less happy, but so be it.
That's the one thing about peer comparisons. They're all giving back the 4%.
Right, right.
Good question, Bob.
Okay, so do we have any action on this in terms, what do we need to?
Yeah, so I'm, up to the board on, do you want to add a policy benchmark? We'll add it to reporting, for you to track. You can update it, it could be part of the monthly update, though I probably won't really harp on the policy benchmark this month versus last month. Like I said, this is really meant to be, hey, this year, how did we do? Would we have beaten this 90 investors? It's meant more for tracking, how did we do? It's the same thing with the 6.9. It's great to see in February that you're up 11%, but you just gave back,
Let me tell you, rephrase it. The only thing I really care about, now that I think about it, is a benchmark that is a blend of what we're invested in. Personally, that's all I care about. In other words, like you said, the liquid portfolio, we're in ETFs that should be tracking the market, less a basis point or whatever. And then we have X percentage of our portfolio is actively managed one way or another. And I'd like to know that we are at least average or better of those categories. In other words, if we have 8% of X and 7% of Y, I'd like to know if there's an index of those categories that we're at least, and all you guys have heard me say this a million times, all I want to know is we're average. I'm not looking for above average, I just don't want to be below. And so to me, a policy guideline that I would be interested in is something you sort of already do, which is that blend. In other words, we're making decisions as a board to be in so much stock, so much bonds, so much international bond, so much equity, so much real estate, whatever it is.
Yeah.
And I just think we should be tracking those decisions, right? Like Nick is saying, it really doesn't matter what Westport is doing or Ridgefield. It matters whether or not we're doing a good job if we are not underperforming, in my view. Underperforming what we've chosen to do. Right?
Yeah.
And the easiest way to do that would be to index everything, but we can't index everything, right? Some things are active by definition, if we choose to be there. And to the extent you guys can give us a way of tracking how we're doing in those categories.
On page 21, that's what.
No, I understand, I'm just
We
saying,
have
that's what would allow me to sleep well at night, would be to say, okay, I think we've done a good job, because we decided this is what we think our portfolio should look like, and this is the performance we're getting. Does that make sense to?
Yeah. It's all, the whole point of I feel like a benchmark is to show the pros and cons of your active
Right.
choices.
Exactly.
And so from that standpoint, the one's going to show the least amount of active choices going against the strategic asset allocation. Because if we have our benchmark that's just the indices of the asset classes we chose, then there's be a little bit of deviation.
Could I weigh in on that?
Policy,
Hang on a second, Tom, hang on.
that could use like a policy benchmark where we use kind of the more just, whether it's 60-40, 65-35, then that shows the benefits of our active tilt or our strategic asset allocation tilts over the, kind of like the lay portfolio. So,
If we can agree on what that portfolio is, right?
yeah, and I think that would somewhat guidance from you guys. Okay, if we have, you know, just global equities and global fixed income, what's the rough split that we need to hit 6.9 in expectation using your capital market assumptions? So which one would you rather see?
Tom,
But, yeah.
what were you trying to say?
Sorry to speak over you, Nick.
No worries.
On the, I totally agree with the active management versus passive management comments. And I do worry a bit that some of the metrics we're using seem to blend active into overall portfolio. So we don't really see the good or bad choices we're making on the actively managed portions of the portfolio. So my suggestion is that we, excuse me, I've got a little bit of a cold, sorry, that we break out the success or lack of success of our actively managed portion. So, because as I said, if you look at the naive portfolio versus our portfolio, the results are blended across lots of passive investments. So the numbers look very similar in the page I'm looking at right now, but actually the active components are probably very dissimilar.
I think, I think Nick was capturing it. The policy benchmark is meant to capture the SAA decisions that you make.
Right, exactly.
Yeah.
Versus a naive. We do track on the asset level benchmark. So that's what page 21 is. In our quarterly reports, you do get the total liquid portfolio, did all of the passive equities and fixed income track the index, which they should, I mean, they do, they're index. We break that down at the equity level, at the US equity level, at the non-US equity level, the fixed income total level, the US fixed income, the non-US fixed income level. And then to Tom, your point, where you're active and you would expect to see larger tracking error, you do have the private equity has its own benchmark, the private real estate has its own benchmark. So you can tell those specific funds, are they beating kind of the broad market of these asset classes?
And Josh, on that note, I don't mean to, I may be drilling down on something that's not a driver, but just a feature, but the survivorship bias. If we're comparing ourselves to median funds and the survivors are falling away, the failures are falling away, it seems like we're setting a pretty high benchmark for ourselves, a peer benchmark for ourselves. So I guess I'd like to understand if you're comfortable with the benchmarks those active funds are being measured against.
Yeah, let me follow up on the survivorship bias of those pieces. Private equity. Broad.
Sorry to interrupt. I don't mean to make it all about that, by the way. I'm just saying, are you comfortable with the benchmarks in general on the actively managed portions of the portfolio?
Yeah, I mean yeah. Sorry.
Isn't that less of a concern with private equity benchmarks though? Because you wouldn't have failures. You would just have funds that run off. Whereas like with a hedge fund benchmark, you might have firms and funds that fail. And then you'd run into
It makes sense. It makes sense the way you're saying it. I'd like to hear Josh confirm that, but yeah, what you say makes sense.
Yeah. I mean that's exactly right. I mean they're going to just be the lowest performing. They'll have very negative performance if they're the worst of the worst.
Bottom quartile.
But on real estate, for example, there's if lots of companies are failing as I'd expect they would be, that would be a tough hurdle to match, I would think. Just to pick one example.
Yeah. Yeah, let me follow up on the end creep on the survivorship bias on that one.
Thank you. But just to emphasize, I think this is a core issue. I think the performance of the active portfolio, I think if I could make a suggestion, I think that's really where I look at some of the benchmark performance and say, if I were looking from the Board of Finance, for example, point of view, I'd say, are we comfortable with the actively managed portion of the portfolio, and if so, why?
Well, it goes to the heart of why we even have a pension board, right? A JRIB.
Exactly.
Right. I mean, this could be just automated, and we wouldn't need to do any of this stuff.
Yeah, I think that's the issue lurking in the background is, are we comfortable that we're actually adding value? And I think understanding the benchmarks for the actively portion actively managed portions of the portfolio would be central to that.
I think there's a broad agreement around the table on this. I mean, we really want to make sure, I mean, I don't think there's anything new. We want to make sure we're getting our money's worth, so to speak. Right?
Maybe these, reference benchmarks, again, will come up at the SAA, at the Broner SAA review, we made these decisions, how did we do? Again, it's really just helping monitor the strategic decisions that you make.
Okay.
So with our decision, what are we gonna decide on or vote on this time? To add a policy benchmark or to add the SAA benchmark to the reports?
Instead of voting item?
Or what do we, I mean,
I'm sure it's
we
a.
gotta decide on something.
Isn't your
Well,
recommendation?
our
a policy?
recommendation was to add a policy.
Add a policy
benchmark. So, if there's desire to add one, that would be a vote, but there's no desire to add one.
Yeah, I think there certainly is a desire, right?
Yeah.
Okay.
I'm gonna make a motion.
I guess, would somebody like to make a motion that we,
I'll make the
Go ahead.
motion that we add a policy benchmark to our reports and strategic asset allocation
okay, second?
decisions.
Quinn?
I'll second it.
Okay, we already got Tom, thank you, though.
Third and a fourth.
Yeah, okay, any further discussion on the topic? I don't think we need it. Okay.
Oh, quick question.
yeah.
When it comes to the policy benchmark, will you guys make the recommendation, BlackRock will make a recommendation of,
So it's 65-35 for the pension and 75-25 for the OPEB.
that is what we're going with, what is on page 19 and, is it on the OPEB? And then what's on 22? Right?
Yeah, so it's in the
Yeah.
subheader of each.
Okay, just make sure. You know what we're voting on. Okay. That was my last question.
Okay, all in favor of adding the policy benchmark as described? Aye.
Aye.
Any opposed? Any abstentions? Stephanie, you'll see we do a lot of unanimity here at this. Okay. Excellent. Want to chit chat a little bit about the private credit market, and we'll keep it somewhat brief,
Yes.
given the hour.
Yeah, very brief. And I'll add at the top, there's no private credit exposure in the portfolios as we've been discussing what the asset allocation is. So all of the noise that you've seen is not impacting the portfolio directly. The news and notes really kind of stem from back in the fall, the first noise, as Jamie Diming calls it, which is underwriting of certain loans in certain funds didn't look great. A couple of loans had to be written down. The private credit as a whole, what we're talking about here is specifically in what we call the direct lending universe. This is a subset of the broader private credit universe that includes opportunistic and really high return seeking types of strategies. Direct lending is really just meant to be a higher income generating portfolio. Loans are underwritten at SOFR plus a spread. That spread is usually 450 to 550 basis points. So when rates are really high, in the 2022, 2023 time, these funds had yields of 12, 13%. Relative to public market fixed income that had yields of 4%, that's generally very attractive. And these loans, they're underwritten by, financial firms. The idea is that, these firms aren't going to a bank. They're not going to the public market and just issuing their own debt. They're going to a fund, and the fund is saying, I have a collection of big institutional investors, or for a lot of these funds became retail investors, that we can collect money and distribute these loans and loan them out. The noise has really been in these public, what they call BDCs, or business development companies. Business development companies have been around for a long time. They're a legal structure that's meant to be used to lend to small and mid-sized companies. I mean, that's what they're used for, and that's what a lot of these direct lending funds do. They loan not to your mega cap tech stocks. They're lending to mid-market size, small mid-market size companies. The big themes have been rates have started to come down. The Fed has cut rates. So that SOFR number has come down. So these are all floating rate issuances, which means that every quarter they reset what the yield and the rate that these companies repay at. Those rates have come down. That spread between the ag and these direct lending funds has compressed. It's not all the way there. You're still seeing these funds over 9% yields. And again, the ag is still in the 4s. So you're still getting a nice income out of that. But the big fundraising of these funds, these BDCs were about 100 billion pre-COVID. You're at over 500 billion now. So a lot of the fundraising has happened over the last several years. And similarly, now this is where it kind of ties in. What's in a lot of these private equity portfolios is software companies, technology companies. And so you saw some loan disruption, non-software related this fall. The first one was First Brands. They're an auto parts manufacturer. But you've started to see in January, February, that this SaaS apocalypse. And so if these loans are being generated to be issued to software and tech companies, and AI is going to make their companies worthless, then these loans are theoretically worthless, right? And so, the valuations of these loans and the valuations of these companies hasn't disappeared. The equity of these companies still exists. These direct lendings tend to be first lien or the highest order in the debt capital structure. And so if a company did go bankrupt, you're still going to be the first one repaid. And so there hasn't been necessarily damage to the fundamental value of these funds, but it's more of the investment vehicle structure. There are these publicly traded BDCs. There's also these non-traded BDCs that are only available to trade quarterly. This is where we talk about the idea of gating, and that's been the biggest story here, is that these big firms that have these funds are getting redemption requests for 10+% of the overall allocation. And these funds all have a gate set at 5%. And so they've all come out and said, we're going to gate at 5%. And that's been a lot of the risk here. And a lot of the investors who are getting hurt here are more your high net worth, working through retail advisors who certainly saw this is a great way to get income and yield. They're not necessarily thinking about being a long-term investor. And so when equity markets get scary or software gets scary, there's a run to the hills because I want to get my cash. I don't want to be the one holding the bag when this gets written down to zero. You don't see as much of a run on the non-traded, or a lot of the institutional investors use more closed-end structures. So they're not trying to liquidate your money as in the fund for 7 years. Now, the liquidity in these loans, it's still there. Somewhere between 12 and 20% of the loans mature each year. And so as those loans mature, the cash is there to pay this out. They just can't pay out 15% of the fund today, which is why they gate. They don't want to sell these loans at losses, but they're going to collect the money on these loans. The recovery rate for anything that does default has still been around historical norms. This hasn't been like the loans go to zero and there's no recovery on anything that actually does default. And so it's a bit more, I think a little bit of a disconnect between maybe understanding of the vehicles and understanding of the asset class, kind of this consideration of I'm going to get 13% and there's no duration. And so when rates move up, I'm not hurt by duration moving up. And a lot of it is probably a miseducation to some of the retail investors that are ending up in these funds. And then when they want to get their money back, realizing that they can't.
They can,
They just get gated. I think that the broad expectation across these assets is that, the gates will be up, but these funds will liquidate. Something very similar happened in the private REIT market back in 2022, which was when real estate prices collapsed. And then these REIT funds all had assets that were way undervalued and everyone ran for the doors. An interesting note will be, what does the next couple of years in this direct lending market look like? That basically, what happened with the REIT market is fundraising fell off a cliff. Some of that's related to real estate, took a couple of years to stabilize. If there's still this risk appetite, the private credit market likely will stay kind of with the attractiveness that people view it. And, fundraising might not be hurt, but that kind of remains to be seen where we are. It's a bit more chaotic. And I think the big takeaway is these aren't risk-free investments. And some of this is normal course of business. Businesses go out of business all the time, and some of them are happening in this private credit.
So we have we've participated in secondary funds for
Private equity.
Private equity, and I'm guessing that funds will start cropping up. I don't know what they'll be called, but.
Potentially.
to pick
Again,
up
these tend to be short duration loans. They have 5 to 7 years of maturity. And so one of the things that'll happen is the loan will come up for refinance and they just won't reissue. And Apollo won't say, well, let's enter into another 5-year loan with you. They'll just say, sorry, go somewhere else.
I didn't realize, so you're implying there might not be quite as much of an opportunity.
There might not be as much of an opportunity, but, if, the risk in the asset class stays pretty contained, there's opportunities to go in if there's, less demand, some of the prices come down, it might be a little bit more attractive. Or if there's, a little bit less demand, there might be a reason for the lenders to increase the spread on the SOFR, and so you can pick back up yield to kind of attract the money to loan out.
Also, in the public area, these things are already trading, well, the problem with the NAV is we don't know how real the NAVs are, but, so in other words, you have these BDC funds where the most recent net asset values have most likely been printed in December 31st of 25. So it's unlikely that they're really worth 100 cents on the dollar. But a lot of even the good, whatever you want to call the good names in that sector are trading, I think somewhere as low as 30% discounts. Most are at 20% discounts. So to the extent that, I was just thinking that one of the reasons we're with a group like BlackRock is that they have a deep research capability. And there's got to be BDCs that are better than other BDCs. And usually the baby is thrown out with the bathwater. And there's going to be some BDCs that are trading at a 20% discount where that's a deal, so to speak. And there'll be others that it's not a deal, right? And we're not generally very tactical here, and that's why this may be moot at the end of the day.
It's like
Buy
Bose
Blue
Weinstein
Owl or something.
already jumped in and did this. He's like, I'm just blindly buying all these things that have discount and assuming that I buy enough of them, I'm gonna.
Yeah,
Not all bad.
we're probably, for
By itself.
bigger
Driving
institutional
price down.
investors, you're probably not going fully public BDC route, just given there could be huge disconnects between price and NAV. You're a long-term investor, you're looking for long-term return of capital and long-term income, you're likely looking at more of the closed-end funds or these non-traded BDCs that are quarterly liquid, but again, your plan would probably be to hold them for the length of time of your asset allocation. You're participating in the 5 to 7 year cycle of collecting SOFR plus spread, the refinancing of these loans. I think that there still potentially is some shakeup in the asset class relative to how much has been lent to software companies, what the AI impact on some of that is. That may still be noise that we'll see for the next 12 to 24 months, just given how quickly the AI rollout has been and what this means for overall software firms that were part of this big, some of this direct lending is helping fund companies that are going the private equity route. So it's the kind of debt issuance for some of those investments. And so, a lot of that vintage, this recent set of vintage, there is a chunk, and that's why you see the big talk of how much of these portfolios are in software, and you see a very wide range. It's from 10% to 40%. And so that's where manager selection in this category, to Ken's point, there's going to be BDCs you want and investors that you want to invest with, and there's going to be investors you're going to kind of want to shy away from. And so, that becomes part of the manager diligence and manager selection. Similar to private equity, there's going to be bad private equity managers, and a bad private equity manager is going to really underperform.
Again, one step before that, though, is whether or not there's a place for it in our portfolio.
Yeah, there's
As a concept.
Yeah.
Then we start worrying about manager selection and when it's a good or bad time to buy and blah, blah, blah.
Yeah. Certainly there's, I would say that there's potential for private credit. One of the more bells and whistles portfolios with all of the alts had an allocation to private credit. The rationale for having it, especially direct lending, would be we like income. We have to pay monthly benefit payments. So getting extra income into the portfolio means I don't have to sell something else to go pay that benefit payment. You're just collecting income. And so it exists, there is a potential role for it.
I think Goldman's raising a $10 billion private credit fund. They just announced.
Yeah. I mean,
For,
it's,
for new loans or to,
It's buyer's market, I guess. I don't think it's only new loans.
they could pitch
West Street or
certain pick
something.
up if
Goldman, well,
somebody needs to
Goldman,
liquidate.
Goldman has a horribly performing public BDC.
I think it's under the West Street team, so that's all I know.
They're one of the ones that are considered bad, for what it's worth. I've been doing a little reading on it.
But yeah.
Yeah,
Net,
okay.
net, you haven't been impacted by these.
Yeah, well, that was the first thing. I wanted to make sure, because I figured everybody's been seeing this in the news, so it's worth.
I mean, at what point though, is there like enough defaults in private credit that you start to worry about like overflow into private equity?
Yeah, I mean, that, when it gets above, kind of standard, kind of average default rates, I mean, we're still below that. You see it also in the high yield market. You can use high yield as a little bit of a proxy. Those are the some riskier investments on the public side. But, that's when you see it tick. I think Bank of America had a line of like their worst case scenario is like 8 to 10% of loans defaulting. It depends on the sector. If it's all in one concentrated sector, that's when concentrated private equity manager and concentrated sector becomes, something to be aware of and understand, like, are we connected to where these loans are defaulting, which the private equity side is the equity owner, which gets hit first.
Yeah.
That's what we own.
Yeah.
We own the part that will get hit first.
Right.
is-
That's right, we're not in the one, we're not in the one that's at the top of the stack.
Yeah, that's why we don't own any private credit.
So it's like if you're worried about your private credit, you should really be worried about your private equity.
If
Potentially, yes.
If it's doubled up on, exposures.
Yeah. That's right, yeah.
One thing I can be sure is that you guys will be monitoring it and letting us know when we're running for the hills. Eric?
Did we ever get an update report from Jen at Hooker on the investment
No, I don't think we did.
discrepancies?
No,
And
that's a
did
great,
those- And did those numbers go forward to the Board of Finance, which would have been?
I'm pretty sure the answer is no on the second.
No, the numbers were updated. She did update the numbers. I thought you got a copy of the report.
No. Did they get them updated?
Yeah.
Oh,
Well, at least, yeah, they did.
can we get them for our next meeting here?
I'll check with the tomorrow.
Okay, I appreciate it. No, I didn't see them. Nobody sent me that. Okay, thanks for reminding me about that. Yeah, no, it's important, to say the least. And I don't think they went to the Board of Finance. I don't think. They don't
We
go.
have, they were in the budget, some of those numbers in
Yeah.
the budget.
Budgetary.
Oh, right, exactly, yeah. Okay, but you're saying they've been fixed?
Yes.
Okay, yeah, if we could get those for our next meeting, Tom, that'd be great. Thank you.
Thank you.
Okay, thanks, Eric. Is there anything else on the old or new business? You ready to go?
Go for it. I'm ready to go.
I'm just teasing. Okay, we'll be merciful here. I'm gonna assume nothing on old or new. And we have a motion to adjourn?
Motion to adjourn.
Second? Caroline? Okay.
Next second from.
All in favor? Aye. Thank you, everybody.